All right, let's get started. Thank you everybody for joining us today. I'm sure there'll be a couple more people streaming in along the way. We're here today to discuss Art88. It's a 294 unit apartment building in a very well located area of Miami. I'm sure you guys like us follow the headlines. Miami and Florida as well has been just a huge area of growth. So we're extremely excited about this opportunity. And as you know, many of you are new investors to us, but we also have existing investors as well. So we offer the ability to invest directly into specific assets, which is what we're doing here with Art88. And then we also offer the ability to invest via a fund, which is also investing in Art88, but also will spread an investment over 15 to 20 other multifamily properties. Next slide, please, Marla. So my name is Andrew Lucas. I'm the Director of Capital Markets here at Tryon Properties. So if any of you have follow-up questions after this, feel free to reach out to me. Or if you are interested in subscribing, feel free to do that as well. And we'll be posting to the chat room a link where you can request information. So you'll be able to view and download the full PPM, Tryon's track record, et cetera. And then we do have an online investor interface where you can go through and sign all of the documents electronically. So you won't need to print the paper or whatnot. Then shortly, I'm going to hand it over to Marley Dominguez and Max Sharkansky. Marley runs our acquisitions in the Southeast. So he's really the one closest to the deal with a tremendous amount of knowledge. And then in addition, we have Max Sharkansky here as well, who's our co-founder and managing partner. And I think one of the things we like so much about this asset and area is we actually have boots on the ground. So Tryon, we have an office in Los Angeles, and then we also have an office in Miami where Max and Marley sit. Next slide, please. So before I hand it off, just a little background on Tryon. We've been around since 2005. So, we're not the newest sponsor on the block. We've been around almost 20 years. We've done about $1.2 billion of acquisitions to this point. We've exited 40 assets. And on the 40 assets we've exited, we have achieved internal rates of return over 30%. So we have this robust track record, and we've demonstrated the ability to make money as a company and for our investors in good economic times and in bad economic times. So with that, I'll hand it over to Marley. Hopefully you guys have a little background on the company. Marley and Max will dig into the deal. Marley, you're on mute.
Sorry about that. As Andrew mentioned, my name is Marley, and I run the acquisitions team for our Southeast region. This is our fourth deal in the last year in the Southeast, first one in the Miami area, but we've looked at 50 plus, 60 plus assets in the area. And in our opinion, this has been the best return for what it is that we've seen of those 60 or 70 deals. We had an opportunity to pull the trigger, and we did. So the deal is 87.25 million, built in 1971. It is in Doral, which is a very, very urban infill area. What's happening right now in the Miami market, downtown, Brickell, these areas are becoming significantly more expensive. I used to live here 5 years ago, and I was paying $2,000 for a one bedroom. Now you're paying north of $4,000 for a one bedroom. That's priced a lot of people out. They're going further east. Doral is one of the biggest benefactors of that due to a significant amount of amenities that are in the area and a fairly good school system by South Florida standards. Just some deal metrics here. It's 87.25 million. That's just under $300,000 a key. There's an asset that is a bit newer, but in a worse location and with worse surroundings that also traded at the same time for $400,000 a key, just under. So we feel really great about the basis. It's 294 units, like I said, built in 1971. The plan here is to renovate most of the units. So that'll be a 4-year hold. The in-place cap rate is a 3.7. That's actually pretty attractive by any Southeast standards. In South Florida, that's considered really attractive as you're going in T12 or T3 annualized cap rate, especially given that there's so much upside to this property. And you can see that with our stabilized yield on cost expected to be almost 5.6. The untrended yield on cost is 4.79. That might look, to be honest, that's actually a fairly good number for South Florida. That might look a little bit low from our standards. The reason being is because the assumptions we're making is that we're going to renovate roughly half the units. If we were to renovate all of the units, this return on cost would be a little over a five rock, which is, I'm not sure that we've seen, frankly, in South Florida. So it's really unique, especially for such a supply constrained market. Because we're only renovating half the units, we have an exit cap at 4.25. That's about a 70 basis point spread from, or 60 basis point spread from what we're buying at. The IRR is just under 20, an investor level of a little over 15.5. Sorry, 1 second. So we've been through most of this. The property, the current owner does seem, they are doing renovations, but they are managing it for occupancy. That's why basically when a property is going through renovations and it's at 98% currently leased, what that means is they're not charging enough for rents essentially, because you're going to have 5 to 7 units under renovation at any given time. So even those units that are being renovated are already pre-leased is kind of what's going on. And that just speaks to what's happening in the market here. So Doral touched on that a little bit. Where this property is, it's as the crow flies, it's about half a mile, maybe a mile at most from the edge of the airport. So it's very convenient as far as that goes. To get to downtown is, well, depending on traffic, you're probably talking about 15 minutes. It's a really easy commute. And the other thing that's really nice is that regardless of what direction you go, there's kind of a new retail area. One of the biggest ones, I believe it's called Mall of America, is just to the east. It's essentially walkable. It's one of the largest malls in Florida. It's fairly new. It was completed several years ago, and it's huge entertainment options. It's massive, massive amenity for the area and for this property. You have a few other retail areas that are just like that, about 2 miles to the north. Another one's a mile to the south, 2 miles to the south. So no matter which direction you go, you have a lot of amenities in this pocket. There's also a charter school that abuts the property. And that is, I think the ranking is a 10 out of 10 elementary level. So that's pretty outstanding. And it's a really nice thing to have as well. And then you even have Trump National Golf Course, which is a really, really high-end, very well-known golf course that's just down the street as well. Also in the micro area, one thing to note is that almost all of the apartments are condos. They're for sale. So the actual rental market is not as competitive as you find in other parts of South Florida. Given how dense it is, there's a really low amount of rental units. I'm just talking more about the kind of the work centers. So this is a couple things. I'll talk about some of the renovation plans we look at doing. So we'll rebrand it. Personally, we're not in love with the brand here, so we'll redo that. We're gonna do a little bit of repainting. The property is repainted recently. You can't quite tell from those pictures. Maybe a little bit off to the far right. You can see they have kind of almost a battleship gray at parts of the property. We'll want to remove that. So we'll be doing a little bit of painting, not much. A lot of landscaping though, as well. This is the clubhouse. The clubhouse has been renovated. There's not a whole lot to do. We'll put a little bit of money into it, but it was renovated fairly well, and there's not much that we'll need to do here. So one thing to talk about is the renovations done by the current owner and the previous owner. Believe it or not, it says unrenovated kitchen. That's actually incorrect. I mean, we call it an unrenovated kitchen, but actually this is a kitchen that the owner did renovate, where they put in wood countertops. You can see they did the stainless, which is nice, but you can see this is far from what we would call a modern renovation. So this is what they call a partial. We would call it more of a classic But so there's a lot of upside even on some of the units that they've done here. We'll keep the appliances, of course, but we will put in a solid surface, new shaker style cabinet doors, the bathrooms. So you can see they also have the tile. It's really quite a beige tile. It's hidden by some area rugs here, but we'll float kind of a wood look vinyl over the top, which is in demand in the market. One other thing to note here too is that we're going to be putting in washers and dryers. This market is one of those rare markets where there really is $100 premium to have washers and dryers in the units, because a lot of the properties are so old. A lot of them just don't have it. So it is kind of a rare thing to have. That closet that you see in the back of this picture, that's actually an exterior wall closet. So that's where we're looking to put the washers and dryers. And that is a huge premium to get that extra $100. So this is the current owner did do some full renos, and this is the spec that they did. So you see the quartz countertops, the new shaker style cabinets, the backsplash, stainless steel appliances. This is more along the lines of what we'll do. I can't say it'll be these exact color options, but we will do the white cabinets and so on. And these are commanding quite a premium. The bathrooms. So there are 2 pools in this property, which is an advantage over a lot of the comps. This is the one that was essentially untouched. We put money in the budget to renovate this pool. The other pool is completely renovated with nice new pavers, little gazebo area, things like that. So we'll bring this one up to a similar spec, add in barbecue areas, but to have the 2 pools for kind of under 300 units is a really nice amenity. Actually, you can see in between those 2 buildings off the left, that is the charter school that I was referring to. So it is literally at the site. So you can see they renovated the gym here. They did a pretty good job. We might add a little bit of equipment. There's a little bit of unused space, but not a lot to do. The barbecue area, if you go 90 degrees to the right, this is actually sitting on a nice water feature. It's completely unloved. We'll definitely do something nice here, add a built-in barbecue, maybe a gazebo of some sort, but we will definitely make this more of a feature in the property. It's completely underutilized. There's a few different pockets of water here throughout the property that are completely unused, and we will add amenities to make that more of a draw. Just a few more pictures here. Talked about the location. So the demographics. Miami is a tough one to look at the demographics, at least on the income side. For whatever reason, it always shows a lot lower than it is. But the demographics on the property, I'll have to double check. But I believe Max maybe remember. I believe the recent trade outs were over 100,000 for the property. But we'll double check on that number. But the population growth is expected to be massive, as it is for all of South Florida. So these are sources and uses. The debt we're looking at is coming in from Starwood, around just over 75% loan to cost. Will be about 23 million of equity. And we do have the signed term sheet there, and we are moving forward with that.
One thing to touch on as well is Max and Mitch, our 2 co-founders, are putting in $5 million of their own capital into this transaction. So not only do we have boots on the ground, but the 2 guys that run Tryon have about as much skin in the game as you could have.
It'll be at least 5. Mitch and I currently have $8 million in an exchange, so we're considering putting all 8 into this deal. If it gets over subscribed, which it may, considering how much demand there has already been and how much demand there is for multifamily in Miami in general, then we'll take 3 or 4 out of this one and put it into a different one. So it'll be somewhere between $5 to $8 million of our own money.
So there's the expected investment cash flow. This is a unit mix. As you can see, there are 3 different unit types. One bedroom, one type of 2 bedroom, sorry, 2 types of 2 bedrooms. And all at various stages. As I mentioned, where it just says 1 bed or 2 bed, that is a very, very classic state where there's literally metal cabinets type of situation. The partials are the wood counters that we talked about. And then the actual renovated ones are the pictures that you saw where it had the quartz, and the new white cabinets and that type of stuff. So you can see there's, unfortunately, the current owner, as they changed renovation statuses, they kind of did the accounting of the unit types very strangely. So the premiums that are associated with those unit types aren't shown here, unfortunately. But in the lease trade out reports, we can see exactly what's going on. Lease trade out report being what's happened over the last month, essentially. And the rent numbers are extremely strong. So these are 3 unit types. I have to say too, for, typically you would look at a 2+2 at 842 square feet as a little bit small from a square footage standpoint. For one, it's in line with the submarket, but 2, it's really laid out quite well. It feels very spacious, which is always helpful. So sales comps. As I mentioned earlier, there's another project called West. Just move my screen around here a little bit. Called 7 West that just sold. It's not on here because it hasn't closed yet. It's closing at the exact same time as this one. But that was a 1984 vintage asset that's selling at $400,000 a key. So a significant premium to what we're paying. It is aesthetically a little bit nicer. The amenities aren't as nice and the location isn't as good. And the surroundings are definitely not as good. So in my opinion, this is a preferred property. We had an option to purchase 7 West, by the way, but we chose Art88 over that. So some of the comps, this is about, well, you can see 7 West, by the way, all the way on the left there. Downtown is to the right of the map. You can see the airport almost across the street. And you can kind of see where it says 275 Fontaine Park. That's the Mall of the Americas I was talking about. You can see it's literally just a block away. It's walking distance from the site, and it is a fantastic draw. So rent comp overview on the ones. The one thing to note here, it's what they're getting for fulls. They're already getting the rent that we have penciled in for fulls. So we're not forecasting at this point. We're just matching what's already happened, which is a very unique situation to be in. So if anything, I'd say our rents are conservative here. This market is moving significantly. We got a lease trade out report yesterday or 2 days ago, and we got another one a month prior. Rents went up $25 in that month. That is a very excellent clip. But they're getting $19.25 right now for the full renos. That's what we're forecasting. As you can see, that's still towards the bottom of the market. For the twos, same thing. 7 West, I keep going back to. They've actually raised rents a bit more now. I think they're at $25.25. It says partial. It's actually more of a full reno, with the exception of they have these really kind of not super nice beige tiles throughout the units. So that, I guess that's why it says partial there. So it's not technically a full reno. About a third of the units, for whatever reason, they also put in kind of a pastel yellow cabinetry. in their full renos. Not quite sure why, but that's certainly not going to be as desirable. But so we're essentially matching their rents, and those are in place. So I think that's a very realistic number there as well. But again, even these are renovated rents, you can still see they're on the low end of the market. So this property is the one worth talking about just for a minute. So this is a brand new property. It's about 120, 130 units. It's a couple hundred feet from us, or sorry, it's 133 units. Yep. A couple feet from us. It's brand new. It's obviously a much nicer spec than our property. The rents are higher, but they're not significantly higher. We weren't too concerned about this one for a couple of reasons. One is it's 100% occupied. Two, it's not managed. I went there 3 times. There's no manager there. The lights are out. There's just nobody doing anything. I guess they're managing it for occupancy. But the supply is so low because it's so few units that it's not really going to be competitive. My expectation is as people start to move out, they will raise their rents quite significantly. But this is a small blip in the overall market anyways. The Birchwood, I mean, here you can see their rents are almost what we're forecasting, and you can see from the state of the units, it is a far cry from a full renovation. It is extremely classic, but they're not much lower than what we're forecasting. Newer property, but again, their rents are $500-600 more than ours. So that just shows you what newer properties should be getting as compared to that first one that we talked about. Same thing here, 5-6, in some cases $700 more. And this is, well, again, same thing. We're showing a lot of new properties here simply because there just aren't that many rental properties in the market. This is essentially every rental property in the submarket right now. This is 7 West. There you can see the yellow cabinets that I was talking about. That's considered a full reno. So we're essentially matching the rents of that property, even though we're in a better location with better amenities. So we feel pretty comfortable about that rent. So like a lot of places in the Southeast, the rent growth is tremendous. It's expected to continue that way in the really near, mid, and potentially long-term future. One thing so Green Street, which is a real estate data resource, has pegged Doral as number 5 out of 5,500 markets for the best forecasted growth in profit per square foot. So what that means is it's an outstanding micro location. The forecasts are extremely strong in pretty much every way here. So vacancy in the last year has gone down 300 basis points, which is huge. Job growth has gone up significantly. This is kind of a story I expect a lot of you know. You can see Miami's population growth is far outpacing the United States, and that is not expected to slow down. With lack of supply and rising rents, it's expected that sales price per unit is only going to increase significantly. You can see here that kind of growth in Doral specifically, the blue line is going to be even more. Same with rents. What's kind of wild is that even, so next year they're expecting an average rent growth of kind of 12 to 13%. We've modeled 4, I believe. So significantly below what pretty much everyone is telling us rent growth is going to be. But even in year 2, they're talking about 6% roughly. Again, we've modeled 4. The compounding effect of that delta of the first 2 years on rents at exit is huge. If we put this in, this deal would be a 30%, 35% IRR. Just as a company, We don't do that. We're a bit more conservative on our rent growth. But everyone's kind of saying the same thing. So you can really see where the upside here is on our numbers. This is just kind of zooming into it a little bit more compared to some of the other real estate research. You can see CoStar's rent growth is significantly higher. So over on the right, that's kind of an interesting graph. You can see there's a few projects that are underway that are upcoming, but it's less than 400 units. That first bar that's circled. The second one is just over 200. I mean, in total, you're looking at 1,000 units here, roughly. It is tremendously low over 5 years. For the entire submarket to only have 1,000 units coming to market, given the population growth, it is a far cry from what will satisfy the demand. So this is part of the reasons why you see everyone talking about the increase in rent growth. The supply demand is just so out of balance. And market cap rates here. We're pretty much in line with the forecasted market cap. That said, this actually means we're being really conservative because we're assuming that we sell it with a decent amount of value add still left on the asset, in which case people pay more of a compressed cap rate. So we're just assuming stabilized here. So we're probably 25 to 50 basis points conservative based upon these cap rates.
One thing to add, since we're on the topic of cap rates, and I've had that question come in through Q&A. 4.25 cap does not seem like a conservative cap rate. That's because we're not renovating 100% of the units. And that question came in earlier also. So there's a strategy in the industry to not do 100% of the units, and you do, let's say, 40% of the units, 50% of the units, and you sell it at a lower cap because you're selling some of the upside, and you also have a much larger buyer pool. If we renovate 100% of the units, there aren't a lot of people out there who want to buy a fully renovated 1970s property. So the trick is you do 30 to 50%, you do some of the upgrades on the current renos, maybe a little more, 65%, but probably not much more than that. And then we'll sell the asset. But if we do have a separate model because we like to look at this also as just a secondary scenario where if we renovate 100% of the units, as Marley said earlier, you're getting to a 5 cap basically, and then we would be selling it like a 4.8, 4.85. In this scenario, you're selling it closer to 4.25. Go ahead, Marley.
Yep. So just showing the household income growth.
One thing on household income also that I mentioned earlier in Q&A, what's super interesting here is, these reports they can only be so fresh. They're at least a year old, and there's been a tremendous amount of growth here in the last year or two. And right now, the last 25 leases have an average income of over $100,000 and a median household income of about 92. So just a huge amount of growth in this market. Go ahead, Marley.
What's interesting about this graph is everyone knows kind of the growth in Miami since, let's say, since the 2000s, since the year 2000, from 2010, and from 2000 to 2010, from 2010 to 2020, as rapid as that growth has been, which everyone knows, it's actually forecasted to be more from 2020 to 2030. So certainly no signs of slowing down, and it is only getting harder and harder for new supply. So again, we keep going back to the supply demand dynamics, and it's just really an outstanding one here for people that own properties. Just changing employment post-COVID. Basically, Miami's back, which again, not a surprise. just some comparatives here. Market price per unit, we talked about this. We feel that this is a pretty low price per unit. Really hard to find. The return on cost, really, really hard to find. As you saw from some of the comps, we're already getting the rents that we're forecasting. The current owner is already getting the rents that we're currently forecasting. So I don't know, there's too much to talk about there. It's already proven out. The vacancy rate in the submarket is 2.2. In our model, we assume 5. That's just something we do boilerplate. So there's upside there. Upcoming supply, we talked about this, 340 units annually. It's actually a little bit less than that if you go out 5 or 6 years. And that is it's just so, I mean, it's not even a fraction of what the market will demand. And then Max talked about the demographics. So this is the number I was referring to. If you look at the trade out reports, the demographics of the more recent leases, it's 108,000 average household income. That is extremely high. And it's just a summary, and I think that's it. Questions?
Yeah, it looks like we've got a couple of live questions. I'll just read them all. So we touched on that. Seems like we're relying on the market to push rents at lease turnover. Is that why cash on cash is so low?
Okay, so I'll handle some of the Q&A. So no, the cash on cash is low because of the SOFR curve. We continuously update the SOFR curve. SOFR, as many of you may know, is the index that is replacing LIBOR. And this is a floating rate loan, which is also a question that a few of you have asked. Although we do have an interest rate cap on it, which is how we hedge our risk. It's a 3% interest, it's a 3% SOFR cap, okay? So that means the loan cannot exceed 6% in 2 years. And what was the question? Are we relying on growth or based on, what was it, Andrew? Are we relying on growth?
We got a bunch of them.
Based on household
income? We're relying on the market to push rents, push rents at the lease turnover. Is that why the cash on cash is so low?
No. Okay. So, going back to what I was saying earlier. So because the SOFR curve has such a big spike up in rents over the next 10, 12 months, spike up in rates, excuse me, that will reduce cash on cash. So actually our earlier models had higher cash on cash, but the current model with this, even though we have a little bit of extra rent growth plus the SOFR curve, it has a little bit of a lower cash on cash. But then of course, you have the new incomes, and the incomes have gone from 60K to 100K. So we're seeing a lot of these new rents in the market. It's easily comping out. Next question. We have a list of questions from one person. I think we took care of the debt questions. We had a lot of questions regarding debt. Obviously, people are seeing what's going on in the debt markets and everyone's concerned with interest rates. So I hope I answered that. Loan to cost, we have a loan to cost question, 75% loan to cost. Why is the building being sold? It's owned by a sponsor with an institutional group. They've owned it for 5 years. They've had some lift, and they're selling it to take profits. Any Airbnb restrictions for these units? I don't know. We haven't looked into STRs. Real estate taxes.
I'm sorry. How do we plan on reducing the payroll significantly?
Max, I can take that one. So the payroll question really comes down to just being a little bit more efficient with your headcount. We're going to be getting rid of 2 of the headcount in terms of the outside. So the groundskeeper and they have a housekeeper as well. We're going to be adding a leasing person, and our benefits are a little bit cheaper than the sellers. But overall, we are actually increasing salaries versus what the seller has in place as well. So people will be getting a little bit more in salary, which covers some of the rising cost of labor, but we're a little bit more efficient on the benefits than the seller has been, and we're going to be a little bit more efficient on headcount as well.
Okay.
And just a couple of people have asked, this webinar is being recorded, so feel free to email me if you'd like a recording. We'll likely send it out to everybody, so feel free to email me, but you will get an email with the recording.
What other questions can we answer? 1031, we're not going to be able to do a tick in this deal, so we're not going to accept 1031 money, but if we get enough investors who want a 1031 out of it, when we sell, yes, we get 1031 out of it. Why? Somebody asked about fixed rate debt. It's a bridge loan, which means you can't fix it. That's not really available. Any other questions?
Is a tax increase expected?
The tax reassessment is included. I think that's it. Someone's asking if there is a risk of eviction and non-payment. There is no eviction moratorium in Florida that expired a while ago. What financing is there after 2 years? If when we go to refi, we plan to execute on most of the business plan in the first 18 to 24 months, and then we'll probably go to the agencies to refinance it.
So what is required of potential investors? Basically, you just need to go through our investor portal, execute the PPM, and then we are required to reasonably verify that everybody's an accredited investor. So there's a letter I can provide you that an accountant, attorney, or wealth manager can execute on your behalf, or if you prefer, you could send us like 2 years of W-2s or the front 2 pages of your tax returns.
Sure. And then feel free to email us if you have any questions.
How about, have we, as an engineer, confirmed that the existing plumbing and sewage connections have the capacity for additional washers?
Our in-house team checked. Yes, we always check on that.
Got it. Okay.
With regards to 1031, there may be some properties where we accept 1031 money, but it's usually larger. We have done some of that in the past, but it's usually with 7-figure checks. There may be an opportunity to 1031 on this in a few years from now. There's a good question. What is the primary tenant market workforce? I would say it has gentrified in this market. It used to be more blue collar. Now it's more gray collar. Because households went from 60K a year household, that would be the combined household, to 90 plus. Depreciation is always a big question. Somebody just asked about it. Depreciation will be allocated pro rata to all of our investors, and we will be doing a cost segregation study, and we do accelerate depreciation. We take a bonus on 5 and 15 year.
We've got what's the check sizes you guys are looking for? Our minimum investment's 50,000. We're raising about 14 million. We are opening it up to invest. You know, we've had some conversations, but we haven't officially began accepting subscriptions. We will do that at the conclusion of this webinar. If you've already requested information to the data room prior to the webinar, you'll receive an email with a link to the subscription package. If you've just requested information for to the PPM and data room, you'll receive an email which will give you access to the data room and the subscription package.
Someone's saying that the PPM does not include, includes a cash flow that does not include debt service. It's unleveraged. Marley and Andrew, if we can maybe do a 1 or 2 page PDF, send that to Andrew so he can upload that to Juniper, just showing annual cash flow during the whole period. Although I would think that it's somewhere in the deal brief and they're ultimately made it to the PPM.
It is. It actually on page 20. Oh, this is the deal brief. On page 26 of the deal brief, it's there. So they may have been, whoever mentioned that may have been just looking at the slide above.
May have gotten cut off.
Yeah. We have a question about the kind of the Surfside building collapse. You know, what have we done in terms of due diligence to make sure this property is structurally sound and whatnot?
We got a full PCA on it and they checked the foundation and structure, so it is sound. That was a very different beast. That was a HOA that didn't want to pay for maintenance.
And then in terms of renovations, have we, you know, obviously we're based in Miami, but we haven't done a deal yet. How have we already gotten bids out to a contractor to handle the renos? Somebody's gonna do that.
We've got some contractors in the Southeast and our renos are pretty standard, so we have an idea of how much they'll cost. There's a question on cost seg and how much over the first 4 years. I don't know years 1 through 5 on the 27.5-year life, but the bonus on the 5 and 15 usually winds up being about 10% of the total value of the asset. That's on the low side, so that's conservative. So figure here that would be about $9 million.
We've got a question about the split. So basically the waterfall is number one, it's an 75-25 split over an 8% pref with a manager catch-up. So the catch-up makes it essentially a 75-25 split. So 75% of the profits go to the investors, 25% of the profits come to Tryon as our carried interest or promote. We have a question. What are we doing to hedge against inflation and interest rate hikes? 4-year IO loan is noted. Can you share the DSCR, including the principal payment? I wanted to get a sense.
There's no principal payment. It's all interest only. The DSCR going in is approximately a 1.0. It's a little higher than a 1.0, and then it would go up from there. We probably stabilize in the 1.5, 1.6 range here, and then we would refi out of it or sell.
When is the closing date? Have we set a firm date yet?
It is May 9th.
May 9th. So we typically will call funds about a week and a half prior to that. So say funds are due at the end of April. April 31st.
Loan terms, somebody asked again for loan terms, 75% loan to cost,
I'm sorry,
3
April
years +1+1. The first year is an untested extension. So it's a de facto 4-year loan, which hopefully gives us enough time to get in and out of a crisis if there is one. This interest rate is SOFR plus 320.
So April 30th falls on a Saturday. So funds would be due April 29th. Friday, April 29th.
Somebody again asked about P&I versus IO. This is IO. It's interest only. The loan is interest only. Bridge loans are always interest only. Their principal and interest, bridge loans do not exist. That's more for a stabilized loan. Somebody asked again for the economics. GP on this one will have significant skin in the game because it's a 1031 exchange situation. We will have somewhere between $5 and $8 million in the deal. It is a 75-25 after an 8% pref with a catch-up. Does your GP partner require sale at 5 years like an institutional investor? We don't have a GP partner. It's a syndication. This is not a joint venture where we're syndicating out part of the JV. We are the GP.
And our fund will be investing in this deal as well. So in addition to, the significant investment from Tryon, our fund will also be investing a couple $1 million as well. So we'll have a significant amount of skin in the game.
I'm going to answer a couple more questions, and then we're going to have to wrap up. The greatest risk, I would say it's all. This is very similar to what we buy portfolio wide. We have thousands of units of these older assets built in the 70s, and the risk is a lot of times just what you find once you take over ownership with stuff behind the wall, slab leaks. It's an older asset. You're going to have some issues with plumbing, electrical, roof. It's inevitable. We, of course, try to minimize that by doing a tremendous amount of upfront DD and getting hard bids, but stuff does come up. So your physical plant really is where the risk lies. The deal's in the Southeast. It's in Florida. You might have a Cat 5 hurricane, but we do have insurance, of course. But that would be a major bummer if we lost units because of that, and then we have to bring them back online.
Aside from this webinar, what other marketing strategies is Tryon implementing to help continue to raise funds? I mean, we do a lot of emails. We've done some crowdfunding in the past where we attend conferences. We have a marketing director who's doing Google ads. If you Google passive real estate investing, a little Tryon banner will follow you around when you're searching the internet. So we have a pretty robust investor acquisition program. And that being said, we have about 1,200 current investors, and overwhelmingly, while we do have a robust customer acquisition strategy, the majority of our investors do come to us from referrals of existing investors. So we're very proud of that.
I think that pretty much wraps it up.
Great. Well, thank you, everybody. If you have questions, feel free to reach out here. I'll put my email in the chat. And then, we look forward to hopefully working with you all.
Great. Thanks, guys. Thanks everyone for their time.